Good morning, everybody. So your last homework assignment is due on Tuesday, the 4th of December. It's just covering depreciation, which is the topic of today's class. We have an in-class exercise that takes you through all the ideas that you'll need to be aware of for that assignment. So depreciation is an important subject that has some implications related to how you choose equipment and implications related to the profitability of companies. And so we're going to get into that today, and then next week we'll begin talking about taxes, which is kind of the final piece in the puzzle of economic analysis. So are there any questions before we get into today's new material in Chapter 16? Okay. So there are two different Honda Civics shown on the screen here. And obviously the one on the left is a much newer model than the one on the right. That's loud. Depreciation reflects the fact that over time and through it being used, the value of physical property decreases. And so maybe some of you have heard the notion that as soon as a car drives off the lot, it loses a certain fraction of its value because it's no longer new. If you were going to resell a car, even if it's just driven that first mile that you own it, you'd have to sell it as a used car and it would somehow be less desirable. So that's an example of depreciation. And there are a lot of different ways to calculate how much value equipment loses over time. And we'll talk about why that's important. But depreciation is just that. It's a word that describes how much value is lost over time. Now, when we consider the tax implications of depreciation, we specifically talk about tax depreciation. Sometimes the tax depreciation is not exactly related to the genuine market value of the item in question. The tax depreciation may not reflect how much useful life the item has remaining. So tax depreciation is more of a theoretical thing that exists so that companies can deduct the loss of their equipment's value from their profits. And so it's an annual deduction against income, so that if your equipment is losing value, you don't have to pay profits on that loss of equipment value. So it's not exactly related to the physical depreciation, which is if you were going to resell something, how much could you get for it? There are different formulas that are used to calculate the tax depreciation. And of course, the two are related. The government allows firms to take a deduction for tax depreciation because depreciation is a real thing. But tax depreciation is a little bit more hypothetical. Now, when calculating either the real depreciation or the tax depreciation, you have to start off by knowing how much the item was worth at the beginning of its useful life. And that's called the cost basis. And it's not only how much you paid to acquire the item, but it's also how much was paid to put it into service. And so that can include the installation fees and accessories that have to be in place for it to be used. And in some cases, that can also include the training that is associated with the first acquisition of the item. The book value at some time subscript K, so this BV sub K just means the book value at a certain end of the year. So K would maybe be at the end of the first year, or at the end of the second year, or at the end of the third year. So the book value is the cost basis minus however much depreciation there's been up till that point. So if, for example, you buy a truck that was $50,000 and you know that a couple of years later there's been $20,000 worth of depreciation, then the book value at that point would be $30,000. Any questions so far on these terms? Not everything can be depreciated. And so a company can't take a tax deduction on everything that it buys. There are certain rules and categories of items that can be depreciated. So for the first thing, it has to be used for the business. It has to be related to the production of income. And so there are a lot of expenses that are maybe personal expenses, and so the clothing that you wear on the weekend maybe isn't depreciable, but let's say a Broadway producer who's buying clothing as a part of the show, maybe in that case the clothing could be depreciable, if it's central to the production of the income. Number two is it have to have a determinable useful life longer than a year. And so things that are kind of designed to wear out or are designed to be consumed through their use also can't be depreciated. And so a package of printer paper couldn't be depreciated because it doesn't have a useful life that's intended to be durable. But equipment like machines and vehicles, even office furniture, those types of items can be depreciated. Number three, it has to be something that wears out, becomes obsolete, loses value from natural causes. And so there are some things that are so durable that they just they don't depreciate at all. And so an example of that might be jewelry. Even if the jewelry is intended to be used in a business environment, if it's not ever going to be worn out from its use, then it might not be depreciable. So things have to, it logically follows that if you're going to get a tax deduction for your equipment wearing out, it has to be something that is genuinely going to wear out. So that's the third rule. The fourth is that you can't depreciate the things that you're trying to sell. And so a car manufacturer who's in the business of selling vehicles, they may have lots and lots of cars in their inventory, maybe on car lots at dealerships. It could be that they're just parked in a big lot somewhere. And that equipment, you could argue, is losing value as it's just parked in the sun. It's maybe getting weather beaten. It's becoming less desirable the longer it sits there. But because it's the inventory that's intended to be sold, it's not eligible for tax depreciation, even though it is losing value. And the reason for that rule, I think, is to kind of close a loophole that was in the past perhaps being abused by companies that would just generate a lot of inventory, inflate the cost of it, and then just let it sit and let it decay and say, well, we had all this inventory that we weren't able to sell. Because sometimes inventory is really cheap to produce. Like if you think about software that's being produced on a DVD, they can print that software for maybe 5 cents a copy. But when they sell the software, they may be getting $100 or $200. And so if they just had all this software sitting in a warehouse that cost them nothing to produce, but then they were trying to get the depreciation of it sitting there over time, then that would maybe be a situation where the government felt like the depreciation allowances were being abused. So it can't also be investment property. And so land can't be depreciated for a couple of reasons. Of course, land doesn't wear out. It's not being used up or obsolete. Land is more durable. But because it's investment property, that's another criteria where it can't be depreciated. So at the bottom here, it poses the question, why would a business want their property to depreciate? Now, it's not that a company actually wants and is eager for its equipment to lose value, but there is some silver lining when your equipment wears out, and that is that you don't have to pay taxes on the value of that depreciation. And so if your company earned $1 million in profits, but during that same period, during the same 1 year that your company made $1 million worth of profits, if the equipment you used to generate those profits depreciated by $500,000, then you'd only have to pay taxes on the remaining $500,000. And so that's an illustration of why a business wants a property to depreciate, is because it's tax deductible. And there's even more than wanting to depreciate their property, they have the incentive, they want to depreciate as much of it as possible early on. So they want to take the depreciation sooner rather than later for two reasons. Number one is just the human characteristic of nobody likes to wait for things. You just want to get what's coming to you as quickly as possible. But the second reason, and maybe more closely related to engineering economy, is remember that money in the future is less valuable than money now. And so if you're taking $50,000 worth of depreciation, you'd rather have that now rather than in 5 years, because in 5 years those $50,000 has a smaller current value than if you had the same number of dollars taken today. So these are some of the rules associated with tax depreciation. And so just as a reminder, you're going to have some concept questions on the final exam and lists. Anytime you see a list, that should be a trigger in your mind of, oh, that's something I might want to commit to memory, or it's, you know, if it's an itemized list, then it's maybe especially important. So there are 3 main ways to calculate how much depreciation a company can take for its equipment. The 3 methods are called straight line, declining balance, and MACRS. So let's talk about straight line first of all. Straight line is the easiest of the 3 methods to calculate because the same depreciation amount occurs every year. So it's a linear depreciation model, and if you graph it, how much depreciation is lost each year, since it's the same amount every year, the graph of depreciation, or I guess rather the graph of the value is a straight line. That's why it's called straight line. Now, straight line depreciation methods can include a salvage value. That's what SV stands for. That means that in some certain year in the future, in year N, there's going to be a salvage value. So that's assuming that at the end of the item's useful life, some equipment can be sold just for scrap. Maybe it's got a lot of steel in it, like a car, and so even though it's broken and not drivable, there might be a couple of $100 worth of scrap value to it. So in straight line, you can have a positive salvage value. The next method is called declining balance. And in declining balance, rather than having the same number of dollars depreciating every year, it's the same fraction of depreciation that occurs. And so what we'd say is maybe every year you're losing 20% of the previous year's value. And that kind of makes sense because, well, we'll talk about the details of that in just a moment. We'll show some graphs. Now, the final one, the Modified Accelerated Cost Recovery System, MACRS, it's a system that the government utilizes because people were constantly making errors when calculating the depreciation amounts in straight line and declining balance. Straight line and declining balance require you to actually crunch the numbers of how much the depreciation should be, whereas MACRS uses a table of depreciation factors, where you just multiply the book value by these given factors, and then you'd know for every year how much the depreciation should be. Now, in this system, we use the pre-formatted tables and fractions, but there's no salvage value at the end of the depreciation. So you assume that the equipment goes all the way to zero, even for types of items that would generally have depreciation. We're just in these 3 methods talking about the ways that we calculate it. So it's kind of like a hypothetical accounting technique that's used to keep track of the loss of an item's value. Okay, so before we get any further, let's just make sure that we're on the same page with some of these depreciation terms. We've already introduced the idea of a book value, but the first cost, the cost basis, B, sometimes people will label that P just to mean the present, because the first cost is incurred at time 0 in a cash flow diagram. And remember, that's the total installed cost, including the transportation, the shipping, accessories required to put it into service, and potentially training. The book value at some time, so book value at time t, is how much undepreciated capital investment there is. So the book value is not the same thing as the market value. The market value is how much you could actually sell the item for if you found a willing buyer. The book value is just an accounting measure of how much of the initial purchase price, how much of the cost basis hasn't yet been written off. So the book value is this accounting amount that we'll calculate in today's in-class exercise. When we're using the Macrs method, you look up the equipment type, and there's a table that tells you for certain classes of equipment how many years the depreciation occurs over. So for example, office equipment may be depreciable over 5 years, but then heavy machinery for the production of textiles may be depreciable over 20 years. And so the type of equipment that you've purchased has a pre-assigned depreciation duration. So how long it's expected to last is kind of built into the recovery period. Market value is different from book value because the market value is actually how much it's worth when you find a willing buyer. And so it could be unrelated to the book value of the item. And salvage value is the market value at the end of the useful life. And so even if the item can't be used in its intended way, the salvage value maybe reflects the value of the raw materials that are in it. The depreciation rate is what's used in the declining balance method when there's a certain percentage or a certain fraction of the cost basis that's lost every year. And remember that not all purchases can be depreciated. Personal property is kind of a loaded phrase. Personal can mean actual people, or it can mean a corporation, which is a business that's treated as a person for purposes of taxation and deductions. And so the possession of a company to conduct their business is the personal property. And real property is talking about real estate, buildings, improvements to land, and those sorts of purchases aren't depreciable because they have such a long useful life. And finally, one last term to be aware of is the half-year convention. In the third method that you're going to learn today, the modified accelerated cost recovery system, in that one where you're just given the tables and you're supposed to use the provided fractions to calculate the depreciation, what you'll notice is in the first year and in the last year, you only get credit for half a year of depreciation. So the half-year convention is that it's assumed your equipment is put into service in the middle of the year, regardless of when you buy it. And the reason why they've done that is, again, to try and prevent companies from kind of gaming the system where if you purchased something on December 31st and maybe are trying to take an entire year of depreciation for just 1 year of ownership, for 1 day of ownership. And so to try and reduce instances of that, the half-year convention is that you get a half credit of depreciation in the first year, and therefore that also bumps the depreciation scale down. And we'll see that today. I'll point it out when we're looking on that example. Here's the formula that you can use to calculate straight-line depreciation. It's also on the in-class exercise paper that I'm going to give you in a moment. But the depreciation amount for any given year, so the depreciation amount in year T, is the book value minus the salvage value divided by the number of years that it's in operation. So the book value at the beginning of its useful life. The book value at other times can be calculated by the initial book value, so the first cost minus however many years has been in service, T, multiplied by the depreciation per year. So that's just saying the initial cost minus the depreciation per year multiplied by the number of years. Now remember, in straight line depreciation, the amount is constant every year. So just as an illustration, let's say there's a piece of equipment, an argon gas processor, that has a first cost B of $20,000, and the salvage value is $5,000. So that means it's losing $15,000 worth of book value over 5 years. So if we were to graph that, which is a useful way to kind of visualize the data, at time 0, the book value is $20,000. And what we know is that after 5 years, the salvage value is $5,000. The straight line method assumes that every year you're losing the same $3,000 worth of book value. So that if you wanted to know the book value in year 3, then it would simply be the initial $20,000 purchase price minus 3 years of $3,000 per year depreciation. And so the total depreciation is going to be $9,000 over that 3-year period, which means $11,000 of book value remains at the end of 3 years. So now you can see why it's called straight line depreciation. It's the same amount that's losing value every year. Any questions about this illustration? Okay, just in comparison to that, which is relatively simple, that's the pro, is it's easy to calculate. Now the con is it's not realistic. A couple of years ago when I was thinking of buying a car, what I did was I went online and I gathered data for a certain model that I was interested in, and I created a graph of how old it was versus what the price is. And it wasn't linear. Old cars don't lose value as quickly as new cars do. It's more like this. You lose a lot of value at first, but then the loss kind of tapers off, and it is gradually still losing some value, but year over year, it's not losing the same amount that it was in the early stages. And so that's what declining balance is it's a way of, instead of having the same number of dollars lost every year, you have this shape by having the same fixed percentage lost every year. Now the maximum amount of depreciation in declining balance is twice the straight line rate. And so this percentage, I'll show you before, is often described in terms of the declining balance factor is often described in terms of a percentage. And the way that you calculate the depreciation in a given year is by using that fraction D and multiplying it by the book value from the previous year. So you'll notice here this is saying, for instance, if T was 2, meaning you want to know the depreciation in the second year, you'd use this factor D, which is a fraction or a percentage. So you'd use D and you'd multiply it by the book value in the year before. So if you want to know the depreciation in year 2, then you have to have the book value in year 1 to know how much the depreciation in the next year is going to be. And this is how the factor D is calculated. Sometimes in problem statements they'll tell you like what percent depreciation it is. And so you'd be given a certain percentage and you'd calculate D according to this formula, where N is the number of years in the recovery period. Sometimes there is a certain salvage value that's known at the end of N years. And so if the problem statement says that the salvage value at the end of N years is some value S, then you'd calculate D according to this formula to make sure that at the end of the recovery period N, that it does achieve that salvage value. So the two are mutually exclusive. Either you'll be told a percentage, and that means the slope relative to straight line depreciation, or you'll be told the final salvage value. And then once you know the depreciation in a given year, you could calculate the book value in any year either by row, calculating what is the depreciation for this year and therefore what's the book value. Or if you don't want to do each row individually, you can just jump to a given year, T, by using this formula. So you're kind of compounding the depreciation by T years. Okay, so let's get some practice with this. Just as an illustration, if you had a piece of equipment like a construction truck that had a first cost of $80,000, and you know that the depreciation period is 10 years. Just to show the difference between when the percentage is given directly versus when a known salvage value is defined, this spreadsheet shows that what I did was 150% is given. It's 10 years as the recovery period. And so to use this formula, D equals the given percentage divided by 100 times n. So then that's going to be 150 divided by 100 times 10. And so the fraction is 0.15. So now look at each year the depreciation amount. In year one, the depreciation amount is $12,000 because $12,000 is 15% of $80,000. But in year two, the depreciation amount is lower. It's lower because at the end of the first year, the book value now is only $68,000. And so $10,200 is 15% of $68,000. So you can see the pattern is that this year's depreciation is based on last year's final book value. Does that make sense to everybody? In contrast, in part B here, if we have a known salvage value, this D factor is no longer some nice round number like it was in part A. The factor D is calculated by the known salvage value, the known initial first cost B, and so we've got this D factor 0.1877, and we calculate the depreciation still using this percentage. So the depreciation in year one is still 80,000 times the factor lowercase d, and so on and so forth. But you'll notice that at the end of the 10 years, we forced the book value now to just come exactly to the 10,000 that we knew was defined in the problem statement. So in either case, you'll notice that the depreciation slows down the longer the equipment is owned because the value is lower. Okay, so here's where you're going to get some practice. For this one, you should solve these problems by hand. On part one is on the front side of the paper where we're looking at straight line depreciation. And then when you finish the straight line depreciation, on the back side of the paper has declining balance. So you can get started on that, but I will chime in with the solution to the straight line after I see some folks have got that done. Okay, so the depreciation for each equipment type every year is constant. Doesn't matter if it's year one, year two. Since this is straight line, here in part one of the in-class exercise, the depreciation amounts are constant. So you can see that in each case, it's the, the beginning cost minus the salvage cost divided by the number of years in the recovery period. So I've got those depreciation amounts on the screen there. Okay, I'm going to bring the parts C and D up on the screen. So in part C, where we're looking at year 5, you'll notice that in the recovery period table, the mixer is already lost all of its value by the end of the 4th year. So the mixer has 0 book value in the year 5. But at the end of year 5, you can calculate the book value for the loader and the crusher using the same kind of formula where you're starting off with the starting book value and subtracting 5 years of however much depreciation per year there is. Okay, when you're finished with part 1 on the first page, flip over to the back side of the paper, because that has the declining balance problem. You can use Excel if you like, or you can solve these by hand. I did it by hand, but you know, Excel automates things and makes it maybe a little bit less tedious and repetitive. But what we have is a situation where there's a roadway paving machine that has a first cost of $486,000 and will last for 8 years. Now in declining balance, you're not losing the same dollars each year, but you're losing a percentage that is constant of the previous year's value. So we're going to try both the 150% declining balance and the situation where you're given an estimated salvage value. So the salvage value of $87,000. So those two different approaches, we want to know what is the depreciation, so what's the D, big D, for each of years 1, 2, and 3, and then also what is the book value for each of those years as well. So you're going to have to do it one at a time to calculate the depreciation, because it's going to depend on the book value from the previous year. Okay, so if you wanted to solve part 2 using Excel, here's how you could do it. You could set up a table where you've got all of the beginning information, like the percentage, the recovery period, the starting book value, and then you use this to calculate this lowercase d, which is the fraction of value that's lost each year. And then you have a table where the depreciation in a given year is based on the book value from the previous year multiplied by this depreciation fraction. So you can see that each year is looking at the previous year's book value to calculate what is the depreciation in that year. So depreciation in year 3 is the depreciation factor multiplied by the book value in year 2. I'll also bring up, you know, the hand solution in a moment, but if you want to try and set up with Excel, this is the approach you could follow. So let me show you what the hand calculations look like if you choose not to do it by Excel and instead you do it by hand. Then, for instance, if you do the 150% method, you calculate the factor D, 0.1875, and then you use that same factor each year to calculate what is the depreciation amount for that year. So you're multiplying it by that initial value. And then the depreciation amount of year 2 is based on the book value at the end of year 1. And so you kind of have to do this year by year to know how much the depreciation amount in the following year is going to be. And there's two different ways you could calculate the book value. So look at here on year 2, where I'm finding the book value of year 2. You could have either used the book value in year 1 and then subtract the depreciation amount in year 2. And so 394,875 minus this 74,039, well then that's going to give you the book value at the end of the second year. So that's one way. Or the other way is to use this formula that's shown where you're starting with the initial book value and then you're subtracting it by 1 minus lowercase d to the power of however many years you've had. And so in the case of 2 years of depreciation, what we're saying is 1 minus lowercase d to the 2 power, and that's going to have 2 years of depreciation, kind of like the cumulative effect of those. And so either way, you'll get the same answer. You know, it's going to be about 320,000 whether you do the 394 minus 74, or if you do the starting value minus 2 cumulative years of depreciation. In the Excel method, I did just kind of the successive approach. Rather than using this, this formula where you're having the exponent of how many years there have been, when I solved it in Excel, I just did the book value of the next year is based on the book value of the previous year, minus the depreciation of that year. Okay, so let me scroll down and show you the related thing for when a salvage value is defined. I'll give you a moment to copy that down if you haven't already got to it, because we got to move on to the Macrs method. Okay, unfortunately we have to move on or else we won't have enough time to get through all the material. So if you need to take a second look at the numbers on this in-class exercise, I'd suggest you check out the YouTube video, which will be posted shortly after class. All right, so modified accelerated cost recovery system is an approach that always depreciates equipment down to 0. There's never any salvage value. Now that doesn't mean the equipment actually has no salvage value. It just means from a tax perspective, when you use this system, the government is allowing you to write off the entire initial cost of the item. And so you get to depreciate everything, which businesses like. Remember, they want to maximize depreciation, and they want it to be as soon as possible to get the full value of the deduction. And what it does is it switches between double declining balance and straight line depreciation. The factors that are provided have, at the early part of the equipment's life, like in the first half, you have more than straight line depreciation, and so you're taking as much of the depreciation early on as possible, and then it switches over to straight line to take the value down to 0. Because in declining balance, it never goes to 0, because it's always just a certain percentage. And so in declining balance, you can never depreciate to 0, and so that's why they take the switch. Standardized recovery periods are used based on the type of equipment that's purchased. I'll show you a table in just a moment where different classes of equipment are expected to have a certain recovery period. And the half-year convention, remember, is that in the first year, you only get half a year of depreciation value. And so if the equipment is going to last for 7 years, then that means the depreciation is spread out over 8. And so the recovery period is different than the actual number of years that you're seeing the deduction. So here's a table from your book that compares different classes of equipment and the recovery period. What we're going to be using in most cases is GDS. There are 2 different schemes in the modified accelerated cost recovery system, and GDS I think is the most common of the 2. And so for example, mining equipment is generally assumed that it will actually last for 10 years in most cases, but according to GDS you get to take that depreciation over 7. So since mining equipment is expected to be more durable than buses, that's why it has a longer recovery period. You'll notice that in the GDS system, buses are depreciated over a 5-year period. And so it's kind of interesting to compare different types of equipment and see how long they assume it's going to last. For example, they're saying that electric utility steam production plant, they anticipate is going to have a useful life of 28 years, and they allow you to take the depreciation over 20. So there's some things that apparently last a really long time. Now, once you look up what category your equipment is in, then it tells you which of these columns to use. And so, for example, if you had mining equipment with a GDS recovery period of 7 years, so 7 years, we go to the 7-year column, and then it tells you for year 1, you multiply your initial book value by 0.1429, and that's the depreciation amount for that year. So each of these fractions are based on the initial starting cost basis, and if you add it up, each of the columns adds up to 1. Now, I'll point out 2 other features. Now remember that because of the half-year convention, a 7-year recovery period is actually taken over 8 tax years. In the first year, you have a half portion, and so that's why in each of these rows, in each of the cases, year 1 is less than year 2, because you're only getting a half amount of depreciation in the first year, and then that extends the last year as also kind of a half share of depreciation. So the nice thing about these fractions is that you don't have to calculate them, that they're provided in tables. So to get some practice for that, what we're going to do is apply this approach of where the depreciation in any given year is just the initial cost basis multiplied by the depreciation factor from this table. And so what that means is that the book value at any given year is the initial book value minus all of the cumulative depreciation that's happened up till that point. So let's do that. If you turn to the 3rd page in the handout that I've given you, part 3, we're going to use the modified accelerated cost recovery system to consider the situation of a bus that was purchased for $238,000. And so you start by finding its recovery period from table 7.2. Then once you know the recovery period, you get the correct column out of table 7.3. And what I'd like you to calculate is both the depreciation amount and the book value for every year of its life. So at year 0, what is the book value? At year 1, what's the depreciation amount? What's the book value? Year 2, depreciation amount, book value. All the way down until the equipment is down to 0. You can use Excel for this if you like, or you can calculate it by hand. It's either way is fine. If you want to check your work, I've put the solution up on the screen. All you're doing really is using the given factors, and you're multiplying that given factor by the initial book value to find out the depreciation amount, and then subtracting that out to find the book value. Are there any questions about the basic idea behind MACRS? Okay, if not, let's just take one last look at the announcements for today. Please keep in mind that your final homework assignment of the semester, that depreciation assignment, is due Tuesday of next week. So you've just been through all of the ideas that are included in that assignment, so I'd suggest that you just maybe get an early start. Don't leave it till Monday night. You know, maybe if you work on it today, you could get it done, and If you have any questions, please feel free to stop by my office. I'd be glad to see you and help you out. Or you can send me an email if you have any trouble. So this is in-class exercise 28. And of course, you didn't have an in-class exercise on exam days. And so I guess there are probably 26 papers, hopefully you have in a notebook. If there are any of them that you don't have because you missed class or maybe you've lost it, I'd suggest you try and get with a classmate so you can make a copy of theirs. And if you're not able to track one down, I'd be glad to run off an extra copy for you. If you come see me during my office hours, I can give that to you. I think it would be a really, the A students, people who want to really do well on the final exam, they're going to review the in-class exercises and maybe solve them again if they don't remember how to do certain things. Because the final exam is cumulative. So it just kind of naturally works out that way, that all these concepts build on each other. So I'd encourage you to begin preparing for the final exam early. And if you have any questions, please feel free to let me know. That's it for today. I will see you next Tuesday.